Hello, you are welcome to this lecture, session 6 of Unit 1 for ACC 201D, Financial Reporting 1. Under this section, we'll be looking at IFRS 13, Fair Value Measurement. IFRS 13, Fair Value Measurement. At the end of this session, you should be able to define the term fair value and demonstrate how an understanding of how fair value is measured. So these are our two main session objectives at the end of session 6 of Unit 1. Now the standard of this standard applies when another IFRS permits or require fair value measurement or disclosures about fair value measurement, except for share-based payment transaction within the scope of IFRS 2, leasing transaction within the scope of IAS 17, now being replaced by IFRS 16. Then we have measurement that have some similarities to fair value but are not fair value, such as the use in IAS 36 impairment or the net realizable value in IAS 2 inventory. So we say the standard applies when another standard or IFRS permit or require fair value measurement or disclosures about the fair value measurement, except for those that are measured through IFRS 2, leasing transaction within the scope of IFRS 16. And we look at the measurements that have similarities to fair value but are not fair value. So they look like fair value but they are not fair value. We look at impairment IAS 36. We look at the net realizable value of IAS 2. Now let's look at some definitions. When we say fair value represents the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date under certain or current market conditions. So fair value is basically the price that you would receive to sell an asset. So if you are selling an asset right now, how much will you receive? How much will be your selling price after selling everything? Or the amount you will pay to transfer what? A liability in an orderly transaction. So there has to be some kind of orderly transaction between the market participants, the buyer, the seller, and the various participants in the market. And that has to be at the measurement date. So on the day the transaction is being entered to, what is the fair value prevailing in the market? So that is the measurement date under current market conditions. So the conditions must be that which are current at the end of the day. So that is what we mean by fair value. Now we have fair value hierarchy. How do you measure fair value? So the hierarchy increases consistency and comparability. So when we are looking at the hierarchy, we are looking at chances where we can be able to increase consistency and then what? Comparability at the end of the day. Now the hierarchies are we have what we call the level 1 inputs. Now level 1 inputs are basically the quoted prices or the unadjusted prices in an active market for identical assets or liabilities that the entity can access at the measurement date. So we have similar items or we have same items in the market. Their prices are quoted, so they are the level 1 input, As soon as you're able to identify these identical assets and liabilities, you can have access to their measurement or their value at the measurement date because they are already available. They are existing in the market. So that is level 1 input. Now with the level 2 input, there are input other than quoted prices included within level 1 and that are observable for the asset or liability, either directly or indirectly. So in an absence where you can't find the same asset or the same liability which is having a quoted price in the market, then you have to now go and do certain observations to see whether there are some that are close or limited, or we can just adapt to that one. And with that one is true observation, and you'll be able to determine their value for the asset or liability either directly or indirectly at the end of the day. Then we have level 3 inputs. Now with the level 3 input, they are unobservable input for the asset or liability to the extent that relevant observable inputs are not available. So here we don't have the quoted prices, we don't have observable input or observable assets. All those things are not available. So we have the unobservable input for the asset or the liability, and then we have what we are saying, those relevant unobservable or observable input which we are supposed to get from level 2 are also missing. Level 1, quoted prices. Level 2, input other than quoted prices. They are not quoted, but they are observable in the market, either directly or indirectly. But with the level 3 input, they are not quoted, they are unobservable too. And we have to use this to measure the value of the liability and the asset. Now, what are the valuation techniques? What do we have to do? They are saying the techniques must be appropriate in the circumstances and with sufficient data to maximize the use of relevant observable input and minimize the use of unobservable input to help estimate the price. So with the first one, level 1 input, it is already quoted, but when it comes to level 2, we have to use what the observable input. Level 3, we use the unobservable. So here we are trying as much as possible. The trader is trying to what? Maximize the sufficient data when it comes to the use of this relevant observable input. So they want to increase what or maximize the relevant observable input and minimize the unobservable ones at the end of the day. Now in doing so, we have what we call 3 main approaches. We have the market approach and valuing, or as part of the valuation techniques. Now the market approach, it uses prices and other relevant information generated from identical or comparable assets and liabilities. So as far as we have quoted ones there, and these ones look similar, you base your information or your findings because of those that are identical. They are generated from what? Identical or comparable assets and liabilities. So if you have observable one and then they are identical and co, you can use those that are observable and use it to price it. So we have an example. We have the matic pricing and then the market multiples. They are examples of the valuation techniques. Now the second technique is has to be the cost approach. Now with the cost approach, it reflects the amount required currently to replace the service capacity of an asset, also referred to as the current replacement cost. So with the cost, what will it cost us currently to replace the service capacity of an asset? We are looking at what we call the replacement cost. Then the third approach is what we call the income approach. With the income approach, We convert future amount, that is cash flows or income and expenses, to a single current amount. So we have to convert all future amount, cash flows, income and expense, to what? A single current account at a discounted what? Amount. And this will be reflecting the current market expectation about those future amount, reflecting the current market expectation about those future amount. So the income look at converting future amount to a single current amount now. Cost approach is looking at the replacement cost. How much will it cost you to what? Currently replace an amount acquired, okay, or capacity of an asset. If you want to replace it, how much will it cost you now? And then the uh, market approach was also there, that we are trying as much as possible to make use of or the observable minimize the unobservable input and maximize the observable input in arriving at our solution. Now this fair value is basically applied, you see it in most of the standard that we are talking about. So when you say fair value, this is the standard that talks about fair value, how it is measured, evaluation techniques and co. And if you're able to get the foundation, the understanding here, when you mention this fair value in other standard, you'll be able to what? Understand them. So let's read more, practice more. Now, what are the disclosure requirements? So as an entity, you need to disclose the assets and liability that are measured at fair value. Then you also have to check for effect of fair value measurement using what? The significant and observable input. So if you make use of this significant and observable input, what will be the effect on the fair value measurement? So this must also be disclosed alongside to help users make an informed decision out of the financial statement. So in summary, we have been able to look at the provisions of IFRS 13, its measurements and disclosure requirement. Thank you very much for your attention, and this has brought us to the end of session 6 of unit 1. Thank you.